This is the magic of Reggie.
All right. If you can hear my voice clap once, if you can hear my voice clap twice, if you can hear my voice clap 3 times. Thank you guys so much for coming out to Terminal. This is, what did I say it was? Session what? 13? This is the first session of 2025, and we couldn't be more excited to be back at Earshot with our friends. Bryce hit me up that he was in the city, and I was like, oh, like let's just do something. What day works best? And he was like, Wednesday, and I was like, it's Monday. So we really appreciate y'all coming out on short notice. As you can tell, we are trying to record more and more of these for folks not in the city. And a big goal this year, outside of obviously getting together and hanging out as a community, is to have more of these conversations that shine a little light on the practice of being in technology, whether that's as a designer, as a founder, as an engineer, and noticeably today, for the first time, as a capital allocator. So we're going to talk about a lot of that side, which is a little bit rare, and then allow for questions. Without further ado, let's welcome Bryce Roberts.
Thank you. Thanks for having me.
Let's start with like a quick lore drop for the people that don't know you, other than being the tallest man in tech. Kind of, how do you kind of like self retell your story?
I try to retell my story as little as possible. Most of you don't, like, Y2K is a meme for you all. This is like a fashion trend. This was actually like a thing that happened where I got sucked into tech because I was at a big company when I was in undergrad, and they had to roll out this thing called SAP, because if they didn't get SAP implemented by December 31st at 11:59 p.m. in 1999, the world was going to end and their business would shut down. And so that's kind of how I got sucked into technology. I was well on my way to becoming a lawyer. I always had kind of an entrepreneurial bent. I was interested in that as a way to like build companies. The first time I went to like talk to law schools, I told them what I was interested in using law to become an entrepreneur, and they told me to not bother. And so
not bother being an entrepreneur, or not bother
going to law school.
Okay, right.
Yeah, and so I ended up starting a company. It was a very classically end of the .com company. It was a custom ski maker. We were going to be the Dell Computer of skis in Jackson Hole, Wyoming.
Let's go.
Turns out skis are a terrible business, and it didn't take me that long to figure that out. So I got into .com stuff. I was part of a team that built a business that Monster.com bought in 2001. It was like a kind of Indeed.com of its time. And then I got sucked into venture capital. And I got sucked into venture capital because my neighbor was one, but also because I was just curious. I was really interested in startups. I was definitely like all over. At the time, I was in Utah, so Salt Lake area. So I got sucked into a local venture fund. Within like 6 months, I was like, okay, I kind of like know everything you guys know, and hung on there for the next 3 years until kind of the obvious next step for me was to go start my own firm. So this was 2004, and that opportunity came when I started a conference called the Open Source Business Conference, which was talking about like the business of open source, and it introduced me to a guy named Tim O'Reilly. And Tim, at the time, had just popularized this term called Web 2.0. He had this big conference, and so we kind of put our heads together around what a Web 2.0 fund would look like. And then we raised our first fund under the banner of OATV, O'Reilly Alpha Tech Ventures, early 30s, which was crazy at the time to start a first-time fund. I didn't have any kind of track record, but I was really fortunate to work with Tim, who like everybody knew, and we were able to pull in just over $50 million for our first fund. Before there was like a term for seed investing, but the idea was like what's now kind of conventional wisdom. All these costs are coming down, more ideas, lower investments. At the time, the idea of smaller exits. So the time we started, the kind of talked about acquisitions were like Flickr and Bloglines and Delicious, and like there were a bunch of kind of sub $100 million acquisitions that were happening. There was clearly an appetite for it, but there was no product for it because VCs couldn't make money on a $100 million acquisition. But if you had a small fund with enough ownership, you could turn venture returns out of like this really active, smaller acquisition market.
Yeah, I think one thing that really just stood out to me, because I think it is really different culturally today, is the fact that you said you learn everything you learn, in that small scene of Salt Lake, but you said you spent 3 years before making the bounce. And I feel like culturally today in work, founder, whatever, like waiting 3 years to make your bounce when you feel like you know that you have to make a bounce is a really long time.
Yeah.
And that the world moves significantly maybe faster today, or maybe, I think every generation thinks that the world is moving fast, like in the present, but maybe you could just talk about what you were going through during that 3-year span of like, I know I should leave, I'm not leaving yet for XYZ reason. That feels really unique.
I'm not that bright, and so I need the thing.
Well, listen, most of us are on the left side of the curve.
So yes, I'm definitely like, my life has worked out best when, like, the easiest yeses for me have been the most impactful ones. And anytime I've kind of wrestled with something and rationalized it, it's never worked out as I'd hoped. Mid-curving.
Yeah.
I think after that, like 6 months, 9 months in with that firm, I was like, okay, these guys actually aren't all that into this.
Like you could tell they weren't into their jobs.
Yeah, they weren't into their job. They're like day trading. One was like playing like online poker all day. They didn't know anything about technology. They didn't care that much about that technology. Basically, I realized that like that wasn't the place I was going to be able to build my career. But what I also realized was, it's probably hard to imagine now, but there were not a lot of VCs back then. And so to have a business card, which we had back then, that was a venture capitalist business card, it opened so many doors. And so what I realized was that, A, there wasn't an obvious next thing for me to do that was pulling me out. I talked to a few other funds, but there weren't really that many funds. I mean, you're talking 2002, 2003.
Okay.
But the flip side of it was, I knew that if I could use that card to open doors for me, like as a nobody in Salt Lake, almost anybody would take a call from me or respond to an email or take a lunch or whatever. And so my thing was like, I don't know what the next thing is yet. I know it's not this. As long as I had this door knocker, this like business card that opens up so many doors, like I'm just going to go all out and do this. And so I just used that, effectively as a platform to start building my network, to start learning from other people, meeting lots of other VCs to see if like what I was seeing in the firm that I was with was as bad as I thought it was. And also to calibrate around, when you're in a small market, I don't know how many people grew up in non-San Francisco or non-New York, but like when you're in a tier 2 or tier 3 city, your local maxima for what great looks like is that like the bar is actually really, really low.
Yeah.
And so it put me in a position to see like what great actually looked like and aspire to that and use those kinds of networks. And so for me, I at least had that understanding about myself that the obvious thing was probably going to be the right thing. And when the obvious thing came, it was like no-brainer to do it. It was just, there were things along the way that I started to go down the path of. I'm a big believer in like just kind of keeping moving forward, but there wasn't anything that I felt such strong conviction about that I was like, oh, and you also have to remember, this is Utah. So late 20s, early 30s, I had 3 kids.
Right.
So it wasn't like I was just gonna like, hey, I'm peacing out, I'm gone. I had like real responsibilities too. That wasn't a huge factor for me, just because like our family's just always been taken care of. Like, so we've taken loads of risk, and frankly, doing the ski company early on, I had 1 kid going on 2 when we did this, and I was making $1,000 a month. Everything, like we never wanted for anything. So that for us was like, okay, let's flex this risk muscle early. We saw that we survived that, and it ended up like opening a ton of doors. Yeah. And so, for me, it was just a matter of finding the thing that was worth jumping for. So when I met Tim,
Another obvious yes.
And it was like, as soon as he and I connected around, as soon as I shifted my gears from what I had been thinking about to this. It was like, oh, all the pieces made perfect sense. We had this, partner in Tim, which I don't know if anybody even knows Tim, but at the time, like he coined the term maker. He had Web 2.0. Like he had this amazing platform. I think the year we launched our fund, Wired wrote a huge cover piece on him, like called the Oracle of Silicon Valley. He was an incredible trend spotter and something that, someone I've learned a ton from. And that whole experience not only reinforced the kind of obvious yes, but also completely changed my life.
Sure. And he was in Salt Lake City as well?
No, he was in Sebastopol, California.
Okay.
Which is like an hour and a half north of San Francisco.
Did you move as of?
No.
No?
No. So we were the easiest no for any LP that we talked to because we had never worked together before. We didn't live in the same city. We'd never invested together. Everything wrong about it, but it wanted to happen.
So how did it work out so well?
My mantra through the whole first fund was like, I just need to get out of the way. Like this thing wants to happen, I just need to get out of the way. And at the time, there were so many amazing GPs that were starting funds, and so many of them didn't get their fund done, and somehow we did. And I think there were a few things going on. I think one, the O'Reilly network was such a potent network in terms of access. Like, they had backed Evan Williams at blogger.com. Tim had written an angel check there. Evan had worked at O'Reilly.
Okay.
Like the network around it was so strong that from entrepreneurs, we had a ton of interest. So like a bunch of people that were very excited to be in business with Tim. Tim had bootstrapped his business, so no one could ever invest in anything he did. This was an opportunity to do that.
Got it.
And I think if you were in tech, you were seeing all these things happening. I mean, the mantra back then was like 500K is the new 5 million, right? Like you could do so much with so little. And that was a whole new phenomenon. And I think people who were in tech saw that coming and wanted to get in front of it.
I feel like hearing that Tim bootstrapped his business, hearing the 500K is the new 5 million, I start connecting those dots and seeing how you start to come into some of the indie thesis, which feels kind of like the, son, of that lived experience. Yeah. I'm curious, like, as OATV hits its success arc, that comes to a close. Now it's time for like indie part 1. I know we're kind of in indie part 2 story.
Yeah.
But what kind of guided that transition? Was it just Tim wanted to retire and so you need to start a new fund, or is it something else?
No, pre-retirement conversations, what we thought Seed would be had become something that it totally was not. So Seed originally was like this idea of optionality, right? Like you raise a little bit of a small amount of money and then you can go raise your next round, you can build a profitable company, you can sell early, everybody's happy. What it quickly became was like an arbitrage opportunity. And so what that meant was put a little bit of money in, kind of gussy up the founder, teach them how to talk VC speak, teach them how to like hack the VC algorithm for the next round. And then instead of like slogging it out as a standalone company or maybe getting like a 5 or 6x exit, you can get a 10, 20x markup in like 6 months, 9 months. Like that arbitrage was so big because like our first investment out of Fund 1 was at a $1.75 million valuation. Like pre-money valuation on that company. We did Foursquare, the hottest round of its time. We led the Foursquare round, and we started at a 5 million pre. This was like the hottest company in tech at the time. 5 million pre. Dennis came back right as we were closing. He's like, dude, I have like 5 other term sheets that people want to do. Can we bump it to like 6? So we jumped from 5 to 6. On literally the hottest company in tech at the time.
That just feels so small. Hearing like a 1.75 valuation.
I mean, I just talked to, have any of you used Meetup at all?
Yeah.
So Heiferman, I was just talking to him. His first round was $1 million for 33% of his company. 33% of his company. By Fund 3, we had a company that was really breaking out, and we owned half as much of it for twice the size check that we'd put in before. And so it was pretty clear, like, the game of Seed had like wildly changed.
Do you think that's just like the YC-ification of the game? Because that's what I hear.
I think it's the financialization of it for sure. Like I definitely think that.
But financialization doesn't necessarily mean that like you're going to groom founders into understanding how to create scarcity to then create a 4x, 5x.
No, I mean,
feels like something.
I actually think that is like, I still think we underappreciate what YC did. Like they fully unpacked and laid bare the VC patterns they match against and really taught kids how to hack it. And it hasn't changed that much.
Okay, so I agree with the maybe like we showed kids an opaque world quite boldly.
Yeah.
I don't know if I agree with how they do that for a large category of those companies, which is kind of like intra selling, getting those step ups.
Yeah.
Make like the brand is just the only brand, right? So then they have the deepest incentive to get the 5x because it's their first check that's getting written up, which is also changing. Like you said, it changed what seed was.
I think it changed it fundamentally. And so you also have to realize, like, when we raised Fund 1 in 2005, 2006, there were literally 5 of us doing this. By Fund 3, there were probably like 500.
Right.
And today, there's probably like 5,000 seed or pre-seed funds.
Yeah.
And so, I mean, all of that capital that's matching against roughly the same kinds of patterns, like you end up just getting all kinds of pretty obvious in foresight, actually, second order consequences of that. Is there any questions from that? Like, I feel like I've been like I'm a Neanderthal up here talking to like modern day humans.
Yeah, we could take a quick break to see if there are any questions at all just from this first part. Yeah, go ahead.
Yeah, concretely, like, what does the YC-ification mean for these companies? So what sort of advice would they give?
Just to not take up the whole time, but I do think like the YC-ification is both a layer of education that didn't exist before, combined with a set of sort of investor protocols that didn't exist before, because as Bryce mentioned, there was only 5 investors and that turned into 500. So how do you both organize that and then create competition for your company specifically, and then that has turned into a set of second order effects.
Yeah, my question was, you called the change of what seed means, right?
Yeah.
An arbitrage.
Yes.
Arbitrages are usually short-lived.
Yep.
And then why hasn't, or like, what's your rationale on like why hasn't it changed in terms of the market correcting in terms of what seed means?
I think there's just so much more money, right? Like I think that even the arbitrage has shrunk considerably, right? Like because we were paying 1 to 2 million to certainly sub 5 million pre. So the arbitrage was much bigger when, your seed round or your A round was probably in the like 20 range, right? Now you're paying 20 to 50 for a seed, and like maybe clearing, because you've priced it so aggressively, you're probably barely clearing that hurdle at A. So the arbitrage just isn't as clean, but the competition for that round is. I mean, I think the response to that is what I've been calling like microdosing. So like, people are just raising barely enough, you know what I mean, to like hit a set of milestones, and then they take in like a little of the next little injection of capital. So rather than having these like clear sequential like seed, pre-seed, Series A, it's like tons of little safe notes that like are building towards like one monster round, to kind of cap it off and convert everybody. It's kind of what I'm seeing, at least.
All the way in the back, yeah.
Given that you have this incredible longitudinal perspective on venture. How do you feel?
That's the nicest way of saying I'm old that anyone has come up with. I'm going to have to reuse that. Yes.
Yeah, because you're graying.
So longitudinal. Incredibly longitudinal.
With the rise of secondary and secondary funds and just the secondary market in general, how do you feel that that's changed the system of incentives for the way founders operate and how that affects like sort of seed rounds?
It's changed everything. Fundraising is the business model. When I started, like the idea of a founder taking even $1 million off the table was like so antithetical and so frowned upon. But I mean, we're going on probably 8 to 10 years now of founders at Series A asking for secondary. Like, and that is kind of the goal and the target of raising that round, right? Like it's so, I mean, that if anybody raises more than probably $10 million, someone's taking $1 million off the table. And I think that fundamentally changes the dynamic. Now, I'm neutral on whether that's positive or negative, because I would love to say it's negative, but a lot of the companies that our founders took secondary on, like they've actually ended up being massive returns for us. And so
I do feel like it changes the founder's risk profile, and it's kind of it's a certain level of breathing room that, like, even if this all collapses, like, I am fine, which allows me to keep the same risk appetite as I started with as a founder.
Yeah.
And I think that oftentimes, I mean, it's sort of like, it's like a spring. Like, if I don't get any release, I actually won't be flexible to make any real decisions. And then you start leading, like, out of fear of it collapsing versus fear of it continuing.
I mean, I think there was a big bang moment in secondary. If anybody remembers Secret, does anybody remember this company's Secret? So, yeah, I mean, up to that point, like, secondary was, he's laughing, so he knows. Like, up to that point, everybody, secondary was like $1 million here, $1 million there. This one was like pre-revenue. They had a hockey stick growth, and the dude took out like $20 million or something. I mean, he's like, the next week he's posting pictures of his Lamborghini on Twitter, and people are like, okay, this is our new normal. And I just
some might say that's the first crypto founder.
I think that completely I think it was a Lambo. So I think that completely changed the conversation around secondary. And I mean, that company went to zero. And so that was, I think to your point, there's probably like this balance of like releasing the tension on the spring and then like getting sprung.
Yeah. he was sprung. He was sprung.
He was definitely sprung.
He was sprung. I think this is like a really perfect way into more like indie today, like what needs to change in venture, or at least how do you see your practice changing in venture? And maybe this is your form of arbitrage, or maybe it's like a secret third thing, right? If there's only massive rounds in venture is your model, and then there's bootstrapping.
Yeah.
What is that third way?
Yeah. I think it's more the secret third way. So what kind of inspired Indie were a few things. One, as an investor, I started to feel like I was a feeder fund for the next round.
Sure.
And so when you start to feel like you're a feeder fund for the next round, it starts to, at least for me, it started to influence like what I was looking at in terms of the fundable. And so I just hated that. I hated the feeling of like looking at something and saying like, can I get them funded? Like, can I help them tell their story and like get them in a position to raise their next round in 12 to 18 months? Is this ever something that someone is going to look at and see through the lens of like what's venture scale or anything else?
Yep.
So that started to feel not only inauthentic to me, but I think from an investor standpoint, I thought this doesn't feel like a very durable position to be in. I mean, eventually the big funds will just like come down and start competing with us at this level, and you've watched it happen now. I mean, I'm saying there's now 5,000 seed funds, but there's also every big fund has a seed practice too. So I think that was part of it. I think part of it was we were seeing our ownership shrink, and we were seeing the kind of nature of entrepreneurship becoming much more transactional. And so, we were able to buy less for bigger checks, and so there was that dynamic where I just knew the returns for us at least wouldn't kind of keep being the same way they had been. And then the last one was I got turned on to like a group of founders that I found fascinating. So there was a company in San Francisco where the founders were just like total assholes. Like they were so like antagonistic about venture. They were antagonistic about startup culture, and they were building this company that every VC wanted to invest in, and it was called GitHub. And like, they were doing things that like nobody else could do. They were having things called like drink ups. They were like, they built a headquarters with like a fake Oval Office in it with like an octopus built into it. It was like crazy stuff. All stuff that if I were an investor and on the board, I'd have to like rein in. And yet, these were all the things that were making them like so interesting and so unique because it was such a reflection of who they were. And they ended up raising money and getting fired. They fired the founders like right away. But they like their first round of funding was like at $1 billion valuation. Like they had bootstrapped effectively to venture scale. So I became fascinated with like GitHub, Atlassian, like all of these companies that were coming up and these really interesting, distinct cultures they were able to build because they were able to be themselves and not play anybody else's game. And so for me, I thought, I want to see more of this happen. Pre-founder mode essay, I wanted to see more founders like really lean into those things that made them distinctly different, made their company cultures different, allowed them to pursue ideas that weren't like overly funded, but that were really unique to them. And so that was the original idea of Indie. And in my Neanderthal brain, I thought, well, one way to do that is if they just never had to raise any more money again.
Sure.
So like, what if we put out the challenge, like, we'll provide the first amount of funding and then you go build a business? What would happen if people weren't spending, I mean, how many of you are startup founders? How much of your time do you spend fundraising? Thinking about fundraising, talking about fundraising. Like, it is 80% of most founders' job is like thinking about this and pursuing it. And so if we could give you that 80% of your time back, like what kind of company you could build.
Yep.
And so it wasn't anti-investment, but it was like trying to shift the focus from being so much about who you're raising from, how much you're raising from, and when you're raising next to like actually just building the business. And so we kind of set out to do that. This was probably 2015, 2016 was our first kind of indie cohort. And the idea was like, here's your first round. We called it like the only round you need to take. So the idea was not that you'd never raise again. It was that like you would treat this one like it would be your last one. And, you know, I mean, we did 8 companies and I think 7 of those 8 are still in business. You know, one of them is like tools for influencer marketing. And at that time, like people would just roll their eyes. They had no idea what it was, but it was pretty obvious if you were paying attention to just how big that market would be. Mm-hmm. And they tried to raise money and they couldn't. Because there was a story that like wasn't hot at the time. VCs weren't interested in it. It was here in New York. And so, you know, again, there's like all these patterns and there's also waves. So if you're not surfing the current wave,
yep.
You know, you're in a tough spot. If you're trying to convince somebody that this is your life's work, but it's not, you know, an AI agent company right now, like that's really hard to do. And so, you know, what you see is entrepreneurs will flip that really quick and tack AI on everything to kind of fit into it. And so I think the theme with those was like, we would call them like on trend but out of favor. So long-term trend, but in terms of like the investor community, out of favor with kind of what they're chasing at the time.
Yeah, that's a good bar. What's in favor right now, what I consider like kind of like the 2 massive paradigm shifts of software, right? Which is AI and crypto. Like AI condenses internet. It's just like a new type of software. Crypto is like software that makes decisions, whatever, insert Chris Dixon quote. Like these also fundamentally change the sort of labor to revenue relationship. Yep. Historically, the vast majority of startup costs is just how big is the team, people, you know, and if you have to, you know, cut burn back, you're cutting people back. Yeah. And I think AI obviously has sort of a really interesting relationship on that. And then when you look at crypto, you know, you can turn on a token and the next day it could be worth 100 million in like total value, right? So how have you thought about that as it relates to Indie? Because there is sort of like this mechanism in which this really can be the last check that you need because your second, third, and fourth employee is just Claude. Yeah. And then your cash on hand, right, isn't even USD. It's, you know, token, and token just like went up. And so how do you think about how that's going to change the entire like nature of either your practice or broadly? I
mean, I think that's the bet we're making, right? I mean, I think when we started talking about it in 2015, 2016, it came from a place of genuine care for entrepreneurship. Like it felt like the investor tail was wagging the entrepreneur dog. Like entrepreneurs were just chasing these dollars because they needed them, and that was like the game that was on the field. And I think, you know, for those who hadn't followed Indie, we started it in 2015, 2016 as part of OATV. We took a little slug out of one of our OATV funds to try it out. Then, you know, I then raised a fund after my partners retired. But when I went to go raise like a proper dedicated Indie fund, this was probably like 2020, 2021 maybe. Like I tried for 3 or 4 years to raise the fund and there was zero interest from LPs. And so this was the first
Why?
time in my entire career I'd ever tried to raise a fund and been unsuccessful at it.
Why do you think that is?
Crypto's ripping, like public stocks are like at 30x multiples for like regular old SaaS businesses that aren't even that good. Like they were just making so much money, and I was in there talking about like fundamentals and cash flow, and I was using terminology that they associated with like private equity and not like high risk venture capital. So I think the bet that I was making was like, hey, I was right about seed, you'll trust me that this is like the next thing. And instead it was like I was completely missing the boat on how they viewed their bucket of venture risk, which is like the furthest end of the venture spectrum. And so I'm talking about like cash flow, profits, and they're like, they just couldn't even square that with, you know, rocket ships and what they kind of view as like their big outlier bets in their portfolio. And so I tried for years to convince them that this was going to be a thing. And then, you know, at a certain point I had to capitulate, and I had to wind it down and announce that Indy was done. And at the time that I did that, I really thought that was true. I really thought that like, okay, we gave it a good try, maybe we were wrong. In the meantime, the portfolio is doing great. And then, you know, all along people would say like, all you need is a good downturn.
All you need is the economy to go.
All you need is the economy to like go in the toilet, and suddenly the economy was going into the toilet, and people were like, oh.
Fundamentals, so sexy.
So sexy. So sexy, and I really wrestled with it, because I legitimately poured so much of myself into it that I was like, I don't know that I can do that again, so I'll like go explore a bunch of other stuff. So I kind of did about a 1.5 year walkabout. You could say like I saw all this stuff coming in terms of like AI and crypto and like how cash efficient things could be, or you could just say like I couldn't not do it. And I, like in my terminology, like I couldn't not keep doing Indy. Like I tried to just go back in regular angel invest. I tried to just like do so many other things, but like I just couldn't shake that this was going to be important, and this like secret third option would end up being like a much, much bigger part of the overall venture equation. I never saw it as like changing venture, because I think venture is a very specific kind of product, but I thought, you know, there's another path to kind of plow here. Since then, like all these other pieces have just kind of fallen into place. Like, you know, meeting founders who basically now have superpowers where they can get, you know, there are 3 or 4 people that are getting into tens of millions in revenue is incredible. Like, you know, Pump.fund in crypto is like hundreds of millions in revenue now, like Midjourney.
Yep.
I mean, yeah, for the longest time they
That's kind
were
of like the bootstrap.
Dude, they were doing
dream.
like hundreds of millions in revenue with like less than 30 employees.
Yeah.
It's incredible. So all of a sudden these superpowers come, and you know, I think we can speak authentically about being the partner that would support that path, and I think a lot of VCs can't be that authentic about it.
Do you think more venture starts to look like Indy as the fundamentals of building a business shift more aligned to like the way that you view capital deployment, or do you think that Indy will remain a bit of a unicorn?
I think we still have a lot to prove. Like I think like I think the reason so much competition came into seed was like the results were so quick. You could get these crazy markups, and then when we went out for our first fund, like
just as in like pure feedback loop of how LPs understood it.
In terms of like how much capital they were willing to deploy into it. So from our first fund, which took us almost 2 years to raise because no one understood what we were talking about, to the next fund, like the next fund took us like 2 months to raise. And the whole time we were having people like, we need seed in our portfolio. So I think we haven't hit that inflection point yet with Indy. But I think if I like pull forward the Indy story, it's going to be like, the path for so many founders is going to be one round. They're going to treat it that way. They're going to build these superpowers, especially for this kind of returning group of entrepreneurs who are like, I did it before. I don't want to manage hundreds of people again. I don't want to stay on the fundraising trail. And they're using all these tools. We're already seeing it in like super leveraged ways.
Yeah.
And then every other funding is going to be optional. I mean, we talked about secondary. I think that's going to be a very real part of the venture equation here in a way that like it will have to structurally change, because there will be will be like meaningful secondary involved in like Series A's and B's and C's, because these people have been able, these companies have grown so quickly or so efficiently that they don't need to raise unless there's liquidity involved. I mean, the reality is secondary is a very efficient way for a founder to take money out of a company. Taking it out as distributions and cash flow is not.
Yeah.
Go ahead, Sean.
Focus to me provides the path for I'm not saying build a lifestyle business founder. I'm saying go gigantic, just don't be on the fundraising.
Right.
Optionality to me, when you say that word, I start hearing secondaries. I start hearing you can build a business that it can be a slow business. I've heard that not by you necessarily,
not by us.
around the sort of universe of one round and done type things. That is sort of in the lineage of indie, but not necessarily what you're saying.
Yeah.
And so I think the optionality thing I'm interested in. It's when you say one round and it's you could do distributions, you could do secondaries for the next rounds. That's a little murkier than just build superpowers and go gigantic.
Yeah.
And that's the focus angle. And I don't know if I'm drawing this correctly, but in my head those are the two paths that feel at tension.
I hear what you're saying. I don't feel that same tension, because I think the focus is what I think it maintains all that optionality, but that optionality is totally at your discretion. The one thing that I hear from venture scale founders that haven't been raised, that are kind of off that traditional fundraising track, is everything is opportunistic. And so it's all this inbound that they get to choose whether to engage with it or not. All of this acquisition interest that they get to choose to engage with it or not. And so the optionality is just when you've gone all in on that sequential, kind of treadmill path of building your business, you lose all that optionality.
Yeah.
In many respects, you're watching a bench disappear overnight.
Yeah.
Right? You're seeing these companies and you're thinking, well, you created real value. Why did that have to go to zero? It's because you made that, venture wants you to believe that it's a binary outcome that you're working towards. And I guess what I see the focus enabling is that you have these checkpoints every
scale.
Yes, along the way, and they're purely at your discretion.
Yeah.
Right? I mean, GitHub did end up selling. They sold for $5 billion, but
scale.
Yeah, at that scale.
Yeah, right.
But they had full optionality to do. They raised, but they raised $1 billion valuation.
Yeah.
I think what I'm trying to do in that framing too is I think talking about fundraising. I mean, I think a lot about that. Eleanor Roosevelt quote, right?
Best VC there.
It's I can't even think of the phrase, but it's they talk about people, they talk about ideas. I think to me it's the best people talk about building and ideas. The middle people talk about execution, and then the lowest vibration of it all is fundraising. And I think I just think we spend way too much time. That's the lowest vibration conversation that we have in startups. And so what I'm trying to do is I felt NDV1 was that very low vibration where it became can I raise money? Can I not raise money? I don't know. And I think what I'm trying to kind of elevate it to is a higher vibration where you're talking about here's the things we actually really care about. And when you see your friends or when you see people you admire start to contort to try to fit into this thing because that's what the investors need it to be, I think we lose a lot in that. And I think if you look at just the numbers as they've been playing out, right? The reality is 90% of sub-Series B companies aren't raising money. And these are the exact same companies that were just chasing venture months ago.
Yep.
But it's not there for them. And it's not there for them in many respects because they ended up building something for the wrong customer. They ended up building something for the investor. It drives me crazy when I look and see this world we just came through where money was essentially free, it was flowing in the streets, everything was getting funded. We had, the venture market it tripled in size, and yet we ended up with roughly the exact same number of breakout companies. And so you tell me, is money the problem? I don't think money's the gating factor. I think the gating factor is you start playing this game within the game, and you end up taking what could have been a great business maybe on a different timeline, maybe in a different sequence of funding, and you compress it down to this binary thing that either works or it doesn't, and most of the time it doesn't.
Yeah. Quick question. Can you talk a little bit more about that metagame that you were just describing there? I'm super unfamiliar with VC, so it'd be really helpful.
Okay. How would you describe the metagame?
The metagame is like recording a conversation and making sure VCs see it. I think the metagame is far more of a founder thing than a VC thing.
For sure.
Like I think the VC metagame is kind of just understanding LP incentives, and you kind of spoke to that.
Yeah.
I think the founder metagame, there's just so many versions of it. One version is sort of when he was talking about like founders spending 80% of their time thinking about capital and capital raising, right? So what does that look like in practice? That looks like going around, South Park and just taking meetings, even when you're not fundraising, even though secretly if someone slides a term sheet your way, you're going to spin that round up immediately. It's founders that are constantly seemingly on like the speaker circuit, and you're just like, when are you ever building your company? It's folks that are sort of like trend hopping every other cycle in order to like stay top of mind to the capital class, because the capital class has a mandate to stay on cycle, right? And part of what becomes like this sort of hedonistic treadmill of capital is like only the founder can raise for the thing that they're building, period. No one else can do that job for you.
Well, I also think, and this is probably a controversial take, but it should be a hard process. Like there should be friction in the process, because it shouldn't be easy. If it were easy for everybody to go raise, I mean, we've already established that like funding isn't the gating factor.
Right.
If everybody can raise money, like nobody can raise money. Like it actually ends up flattening it so much. And anyone who's struggled to raise money knows like what a refining process it can be distracting, it can be a pain in the ass, and it can ultimately end up being not successful. But the rigor that it takes for many to like figure out how to tell their story, I think is helpful. I think where it flips is where, I don't know if people saw that screenshot was going around over the weekend of like the kid who said, we've applied to Y Combinator, like it was like 12 times or something like that. And the responses were wild, because they all were talking about like, this is what persistence looks like. And I'm like, no, this is like what building something to get into Y Combinator looks like, and not building something that you really care and like are going to spend meaningful parts of your life to build. Yeah. And that might be a really jaded way to think about it, but I also think there's a certain degree of credentialism that's come into this, where like there's status associated with being a part of Y Combinator now. There's a status associated with like, I mean, I remember you telling me like, I wanted to raise from A16Z. Yeah. And you did.
And we did it.
And you did. But like that was an important thing for you. And I think that's becoming an increasingly important thing for founders. Like there's a hierarchy that's like, we've allowed this kind of hierarchy to creep in, this game within the game, that actually means literally nothing. And yet we ascribe so much value to it that people end up chasing it even more than the ultimate prize of building something that
is valuable.
Yeah, it's valuable.
It's period.
But how do you balance that between building and fundraising as a founder? Like, what would you suggest are steps that a founder could take to stay focused?
I mean, I know the indie answer to that.
Yeah, I think the indie answer is more important than my answer. My answer is mean.
I mean, mine's like, charge people for stuff. Go spend less than you build
a business.
Build a business. And I think people are surprised when they realize like how reasonable that actually is. Yeah. Like I actually think the startup world would have you believe it's nearly impossible, or that it is antithetical, and yet, there are so many companies. I mean, we posted clips of Elon talking about this, or Peter Thiel talking about SpaceX like becoming cash flow profitable pretty quickly. Yeah. We talk about like Facebook being profitable really quickly. Like, if you're focused on that versus other things, then, again, you hit the targets you focus on. And I would say that's a big part of it. Yeah. And I think the value in doing that is like getting close to the customer now, really understanding their needs and what they want, and charging for it.
Yeah. I mean, I think like I wrote this essay maybe like 3 newsletters ago, but it was called like Lies My Teacher Told Me.
Oh, yeah.
And I think that like there's a generation of founders that have grown up on bad advice.
Dude, you all have. If you've been in entrepreneurship for the last 10 years, you have been completely lied to.
Yeah, and I think it's the pattern matching of like what previously worked. And like my example is just consumer founders were told to look at Snapchat, and Snapchat was just a send nudes app for a really long time with no monetization, and then they turned on monetization super late, right? So then the model became like, don't turn on monetization, focus on viral growth, blah, blah, blah. Well, when you tell that to a class of founders, and then everyone's default is don't turn on monetization, you get folks building for 2 to 6 to 8 maybe years, not turning on monetization, and then it becomes a muscle that like atrophies in the system, right? It's
But
something
it tickles that part of your brain where you're like, oh, I don't actually need to know if people want this or not.
For sure, for sure.
I don't actually have to
charge for it.
I don't have to ask people if they value it, right?
Yeah.
I do think it like there's a part of the engineer, the entrepreneur brain that like actually doesn't want to know the answer to that, so they can keep telling themselves
For sure.
that this is that what they're working on matters.
It's the new coddling of the American mind. For
sure.
Some might say. 2 more. Oh, whoa. Okay, maybe not 2 more questions. Your hand was up first.
Yeah,
Sure.
so thinking, with AI, how is the line between operator and VC going to blur, where you kind of have like chariot rider operators that can build apps really fast, they can reach customers, and they're just raising from these funds to back their.
Think about like thesis-driven investing, right? So even think about YC's request for startups. There's no reason YC really has to do that in about 2 years. They'll just take that. They'll take 5 of the homies that sit there all day not doing much anyway, and they will just run those plays until they get bored. And when that doesn't work, or maybe they only get 2 out of the 5 that they need to really work, then they'll do maybe like a little bit different size class. But I think incubations are about to go through the roof, and there's already too strong of an incubation history at a lot of these funds. I think it's going to, 1, change how much capital gets deployed to people, and then 2, I think EIR programs are going to have to do a big rethinking, because currently it's really like hang out at the fund and help us cut checks.
Yeah.
Maybe you'll think of something while you're here. I think it's going to turn into the arbitrage, to keep up that word, is going to just go all the way down to formation.
Yeah.
Right. So if the arbitrage used to be first check-in, I think arbitrage will be EIRs and formation. But I also think it creates a far more mercenary world as opposed to missionary, which I have a spiritual concern around.
I think it also pushes people out of low-hanging fruit. Right, like if in your chariot metaphor, suddenly you want to be building the chariot. So you're seeing this flight to defense tech. You're seeing American dynamism or whatever people are you're watching dollars push and move into categories that are going to be much harder to incubate or hatch repeatably inside of a firm.
Yeah.
I'm curious about this tension in sort of the exit timeline shifting. We were talking about the partners you were working with retiring,
Yeah.
they were receiving returns on things they invested in 7 to 10 years prior,
Right.
which is just not the current landscape, and the pumped up funds of the world that are making hundreds of millions of dollars in year 1.
Mm-hmm.
So, what pressure is that putting on the founders of today and also the VC landscape? You're talking about how can we go back to fundamentals and focus on building when you need to get to your 100x in 2 years now?
Yeah, that's a great question. I think there needs to probably be a fundamental reset in what that timing looks like, right? Most of those examples you used were very much like lightning in a bottle outliers, and we've tried to build a model completely around the most outlier of outliers. Look at the numbers that came out earlier this week. It was how many companies were valued at 500 million or more, and how many have exited for 500 million or more. It was hundreds, if not thousands, that were valued, less than 50 that were actually transacted. And so I think the lightning in a bottle thing, I think that phenomenon is going to continue to be very real. I think the question is whether VCs are involved in those at all, which will be a really fascinating phenomenon to watch play out. And I think the flip side of that is on the liquidity front, these small funds can participate in secondary in a way that most big funds can't. And so you saw with the recent Stripe secondary that they did, Sequoia was a buyer of that, not a seller in that.
That's crazy.
Their fund size, for them to be selling secondary was just crazy, right? Because their fund size is such that they need to ride this thing up to their 1000x, versus a small fund getting a 100x is actually great. So what I'm seeing the smart, smaller funds do is once those valuations start tipping over like $1 billion, $2 billion, they're peeling off 20% of their position, 30% of their position, and in most cases, like returning that whole fund. And so I think that starts to kind of create, it's going to be a weird set of incentives because then you go back to like fundraising being the business model, and as an investor, like really encouraging that. I also think a big part of kind of what's happened in venture is you talk about 1000x. Like when we started in 2005, like $1 billion exit was like a crazy idea. Like no one was selling for over $1 billion, and now you're talking about trillion-dollar companies. And so I would say the inflation that's happened in there, along with the fund sizes, start to really, and then frankly, like the startup industrial complex of like, we had a founder who sold their company for $550 million 2 years ago and felt like a complete failure. So I don't know how we rein that back in. I mean, remember those early Web 2.0 acquisitions? Almost all of them were sub $100 million acquisitions. I mean, Katerina Fake sold Flickr for $25 million and then never had to work another day in her life. Joshua Schachter sold Delicious for $30 million, never had to work another day in his life, and yet it freed them up to tinker and do all these other really interesting things that they've ended up doing. Stewart ends up doing Slack as his next thing post Flickr. So it's like that world, that universe is like so frowned upon. And like think about the early days of YC. Like the idea of YC wasn't to build billion-dollar companies. It was to get paid to join to get your first job. It was like sell something to Google. Like you could go join Google, or you can give them something to buy, and you get like a little extra kicker, right? Like that was, I mean, Paul sold his thing for like $60 million, $75 million. That world is like so frowned upon in startups, and yet I think it's like really, really important to the health of an ecosystem where people can see those kinds of transactions. People are now complaining like that. No one's going to let these big transactions happen, and the reason we're stuck in a big transaction world is no one wants or can support a small transaction. I mean, especially when you're pricing everything to perfection, where your seed rounds of 20 posts, suddenly like that $50 million acquisition actually doesn't look that great for anybody.
Yep.
Given what we're just describing about like the sort of the indie philosophy about staying independent and building real businesses that create cash flow, how do you like think of Nikita Beer?
We spent time last summer walking around Chelsea talking about this very thing with Nikita Beer. I mean, he's embraced so much of this philosophy. Like, I think he's baffled by the same things we are. I think he sees the same opportunities we do. I think he's just courageous enough and willing to engineer his companies in a way to keep that optionality open for himself. Like, he's watched himself repeatedly put himself in a position to generate cash flow, to be totally independent in these things, and like, he maintains all the control. So I think the thing he probably wrestles with is whether like now's the time to take a big swing. Obviously, I think he's probably going to try to take a big swing this time, but I don't know if he's raised money for this thing. I don't know if he will raise money for it. And if he does, it'll probably just be secondary if it's working. And if it's not, he'll figure out the timing and sell it to Snapchat. But I think, I actually do think from an entrepreneur's standpoint, like, I think wanting to get rich is every bit as noble as wanting to change the world.
Yeah, I think specifically on the Nikita thing, I think he just pioneers a specific model that is like ephemeral companies. Like, I think it's a sort of one of those lies being told that's like, if your company doesn't last for 100 years, it's not a company. It's just like, well, if this company can make for Nikita type products like 20 to 40 million in a year and then not have retention, why is that bad? If I didn't take in money, I wind it down, and everyone that contributed gets a big payout, who says that's a wrong thing to do? Just because we don't have like formal institutions around it doesn't mean it's not a thing.
This is something that I'd love to see more of, ephemeral companies. Like people embracing the idea of like, not everything has to be the Beatles. Not everybody has to be touring into their 70s. They get to go off and do all kinds of other interesting collaborations. I'd love to see more fluidity in all of this stuff.
Just to like go all the way back, like history, it's just like financing a ship back in the day. Like, we're gonna put this crew together, they're gonna go out, they're going to get cocoa nuts from this little island, and they're gonna bring it back. And we're all gonna like 100x on that voyage, which only takes, let's say, 9 months, and sure, maybe some locals are upset, but like the merchants in Portugal are happy, the bankers are happy, and it's like that ship is done.
Yeah, we've talked a lot about how products of all these venture capital firms are changing, and I'd love to hear from you, like how you talk about Indie's product. So when founders come to you to raise money, like what is it about the nature of the business that they only need to raise money once? And like, if they need capital, right, given they seem to be able to turn cash flow positive, they're able to generate cash flow super easily after they raise capital from you, why do they need this capital for the first place? What do they end up spending them on? And then second, I'd love to hear about what are the common mistakes you see these founders make that might be different set of mistakes that someone who's running a more traditional venture-backed startup would make.
So on the first question of like what product we offer people and how we pitch it to them, usually they're coming to us. There's something they've seen in the way we talk about it that resonates with them. And oftentimes it's a lived experience with venture that they want to avoid, or there's something about these ideas that we talk about in terms of the higher vibration stuff that resonates with them around independence, controlling their own destiny, this optionality. Typically that tends to be what they come to us for. And when they, our offer to, our pitch to them is like, we're like, a lot of people pay lip service to this, but like we are true to this. And like I got an email from somebody the other day, a founder that we backed last year. It kind of knocked my socks off because he's like, Bryce is like the spiritual heart of our business. Meaning like, they see in Indie the DNA that they're trying to propagate through the whole company. And so here's a company that, I think there was an idea when we met them. There was no product, there was no revenue. But within the year, they got to $1 million in ARR. And that's because they didn't waste any time on the things that so many they just focused on getting to customers. We encouraged them to take on service revenue and contracts that ended up feeding a product roadmap, where most VCs would be like, no, don't, service revenue is a four-letter word. The interesting thing with them was 9 months in, they started getting term sheets thrown at them. And so they ended up having a partner that they really loved that opened up a lot of doors from on the customer and partner side. We closed around with them. So, like they were sheepishly coming back to me 9 months later and being like, hey, I know you don't want, like, are you going to be mad at us if we raise funding? And I'm looking at them saying like, I think it was like a 8x or 9x multiple of what we invested at. And it was the partner they loved. It was a big check. They kept all the control. And they had put themselves in a position that if they didn't want to raise it, they wouldn't. They could say no. They didn't have to take a deal they didn't want. And for me, like that feels like the real value of working with us at Indie. Because I will tell you, having worked with so many traditional VCs, it is incredibly hard for them not to be pushing the next round on you all the time. And that's in part because that's kind of what they've learned and been trained. I would say the second part of your question feels like how do people get to that point where they don't need to raise again? Is that correct? And in that case, it really goes back to the focus on your customer. I mean, unfortunately, it's like Jordan shooting free throw shots. Like the free throw shots never actually make the highlight reel. What makes the highlight reel is this spectacular dunk from the free throw line. What doesn't make it is like the boring fundamental stuff that he was doing that put them in a position to win every single game. And I feel like that's what it comes down to with Indie. And in fact, every time we interview somebody who's built one of these companies, I leave being like, that's it. Like, there's no secret. There's no, like, magic thing that they did that, like, immediately flipped it on for them. It's like, no, charge people early, charge them up front, build something that, like, they have a hand in building. Keep your costs incredibly low. We filmed with somebody yesterday, and we were like, hey, we can film at your office. And they're like, you do not want to see our office. This is not a place to come. And yet, like, there's this thing that happens in startups where people want to project success before they have it. And so if you can resist a lot of those things, I think people are often surprised at how quickly they can get to a level of cash flow break even. I think the flip side of that then is And I think this is so much of the startup industrial complex that gets pushed onto people is like, I remember being in a board meeting and one of the co-investors in this company who said offhandedly, like, oh, weird, it looks like we're going to be profitable this month. They were on the traditional venture path. We had big VCs on the board with us. And the immediate reaction, once the color washed out of the VC's face and they went pale white, they said, well, that's a happy mistake, right? Like, we don't want to stay profitable, right? Like, it was so formative for me in terms of how negative they took that. And I think in general, in the startup ecosystem, it was like, ooh, you're building a little lifestyle business. Like, you aren't that ambitious if you're doing this stuff. You're not taking a very big swing. And I think from a culture standpoint, I think the big part of these indie companies that succeed end up building a culture that really values that, and they value the compounding nature of a business, not just the like external validation of it. I don't know if that's helpful.
Yeah.
I wanted to ask, like, given the system where it's more possible than ever to bootstrap a company and take it 0 to 1, like, kind of on your own or with a limited team, when would you say a company would really benefit from going to a VC? And like, what are some of the unique value adds that VCs can add, like now and going forward?
What's been the most valuable value add you've gotten from your VCs?
I mean, I think just for the Eternal story, it was definitely recruiting very seasoned execs that I think would not have taken me seriously without that sort of authority intro. Our VP of engineering spent 10 years as a technical director on The Sims at EA. I could not really talk to this man without that sort of like authority to speak to, Zerp and what you were talking about before. Like, I think at the end of the day, like, VC has become extremely transactional. Yes, you might make friends and really great relationships. I mean, I met Bryce shortly out of school, and he was like, you're building a business that I would not touch. But it's turned into like a really great relationship, right? And so, I think at the end of the day, it is about money, and it is about leveraging money as a founder to do X, Y, Z. And I think that there will actually maintain certain businesses that have to be venture backed. OpenAI could not happen unless they're raising that amount of money, because at the end of the day, it was a research or going for a moonshot. It's essentially, you're either going to help me get sales, aka revenue, or you're going to help me hire someone that I have no business hiring, or the only thing you offer me is money. Very rarely maybe emotional support. But
so it's amazing. They offer you money and then they're really good at helping you spend it on really expensive executives.
But that exec was necessary.
But I think the other thing, we're honing in on one of your investors, but I think in terms of kind of what VCs can bring to the table or could bring to the table is there is some kind of leveling and like seeing around corners that can be helpful. I think there's also a very human side to building these businesses. Like, the founders are really going through like an incredible crucible to try to bring this thing into existence, and I think that human side of it can get overlooked in the transactional nature of things, but I think a really good investor can be that partner for you to like augment and support the human behind the company and not just like this machine that's building a business. Because each person, like, the thing I reflect on all of the time is like, most businesses don't fail because of external things. Like, most of those problems are coming from inside the house and often between your two ears. Right? And so if you can be the investor that can help kind of navigate that, I think that's just as valuable as helping people navigate the financial markets.
Cool.
Oh, wow.
All right, this is the last question because we're a bit over time.
I swore there was no way we were going to fill 2 hours.
Oh, easy.
No.
I'm going to stand up this time. Been building up on Yusuf's question. So like, given like the whole like Nikita Beer thing, do you think, like, what is your opinion on like the influence of like AI development as, like, do you think AI development is going to like usher in a future of more Nikita Beers in the world? And if so, are little apps the future? And like, will that like kind of enrich like kind of like more funds similar to the indie model of like just raise money once and then like just bootstrap the hell out of it and then just like move on to the next thing?
I really hope so. I really hope they enrich funds just like Indie, maybe even Indie itself. We have a little like pithy thing on our website that says we think 100 million in revenue with less than 10 employees is this generation's 4-minute mile. And I think regardless of how those numbers end up shaking out, I think that efficiency is something that is really going to change the game in ways that we can't even predict. Because I think you said something along the lines of like small apps. Well, I think we're going to I think the spectrum of things we're going to see is like so wide, and I also think the niches that end up proving to be like genuinely generationally huge are going to emerge that we're going to be surprised by. So I think for me, that's a really exciting second order effect of this indie stuff is like how can we promote that? How can we support that? How can we be central to like instigating for that future? And then how can we all benefit from it? Yeah.
Let's give Bryce a round of applause.
And Reggie. Appreciate you. Woo! Too good.
Just like we wrote it up.
Yeah, that's right.